Federal Update, COVID-19 Higher Education Policy, featuring David Musser, Group Director, Policy Innovation and Dissemination, and Greg Martin, Director, Policy Development Group.
Hello, and welcome to today's General Session number 5, the Federal Update for COVID-19 Higher Education Policy. My name is Greg Martin. I'm with the U.S. Department of Education, and I'm joined today by my colleague, David Musser. The COVID-19 pandemic obviously has created some challenges and disruptions for states and institutions, students, and others. Our goal is to ensure that these groups are equipped with resources and flexibilities that will empower students and continue pursuing their educational goals. And we encourage all of you to take advantage of the flexibilities we're going to discuss today in order to offer relief to students and also to limit the administrative burden on institutions. Today's agenda involves an overview of COVID-19 policy guidance, higher education, and then we're going to look individually at Higher Education Emergency Relief Fund, or HERF, and also flexibility and relief that are related to the Title IV programs. Here you see a nice chart which kind of lays out all of our guidance, and it's obvious here, and you're probably already aware of this, that our guidance has been an ongoing thing and has developed over the course of the last few months as this pandemic has unfolded. So this chart allows you to see where we have issued various guidance along the way. And we start here with March 5th, back when the pandemic was first in its early stages. We issued some guidance about relative to interruptions to study that were related to COVID-19. And that was our first major electronic announcement. The next, you'll see there, the Federal Declaration of Emergency occurred on the 13th of March. The CARES Act, on which a lot of our guidance is based, was signed into law on the 27th of March. And here you see on the 3rd of April, another electronic announcement which laid out some major flexibilities related to the COVID-19 emergency. We see here that on the 15th of May, our last major EA on interruptions was issued as well, and other guidance along the way that you see on this timeline. Finally, I would direct your attention to the 8/21 electronic announcement, which included updates to the deadlines for flexibilities related to COVID-19. So you definitely want to take a look at that one as well. Let's talk a little bit about Higher Education Emergency Relief Fund, or HERF. So you'll see this comes from the CARES Act, which we discussed on the last slide, was passed on March, or signed into law rather, on March 27th of 2020, and it provided $14 billion of aid to the Office of Post-Secondary Education under the Higher Education Emergency Relief Act, or HERF. Funds for the student portion and institutional portion are allocated under a formula, which is in the CARES Act. And we're not going to go over that today, but you can find that formula at the link given here on this slide. The types of aid that are included in the Higher Education Emergency Relief Fund, or HERF, are as follows. We have a student portion, which is emergency financial grants to students. There's an institutional portion. There is a portion related to historically Black colleges and universities, tribally controlled colleges and universities, minority serving institutions, strengthening institutions program, or SIP, and finally the Fund for Improvement of Post-Secondary Education, or FSA. With the use of the Higher Education Emergency Relief Fund are some certification agreements that schools are required to execute. And so to receive funds under HERF, each institution must sign a CARES Act certification and agreement. Now, there are separate certifications and agreements for each type of funds under HERF, and that includes the institutional and student portions. The student portion certification agreement can be found at the link given you on bullet number 3, and the institutional portion certification and agreement may be found under the link for bullet number 4. Let's talk about some of the administrative provisions related to HERF. Institutions are expected to spend the HERF funds within 1 calendar year from the date of their award for HERF when they get the grant award notification, or GAN. There is a no-cost extension of up to 12 months, which is available and is provided for in the statute. Funds paid directly to institutions by the department through HERF will not be included as revenue for 9010 purposes. Here we talk about eligibility for students to receive HERF funds. So only students who are or could be enrolled to participate in programs under Section 484 of the Title IV Higher Education Act, or HEA, can receive emergency financial aid grants. So students who have met their Title IV aid limits, such as for loans or Pell, are still considered eligible for the emergency financial aid grant as long as they can demonstrate basic eligibility for Title IV. At institutions that provide both online and ground-based education, those students who enrolled exclusively in an online program on March 13, 2020 are not eligible for emergency financial aid grants. Next, we'll talk about the use of funds. The HERF funds may be used for any expenses related to the disruption of campus operations that are due to coronavirus. And these would include expenses for the students' cost of attendance, such as food, housing, course materials, etc. They can be used for expenses incurred by students after the semester or quarter in which the national emergency was declared. Grants are not included in the student's adjustable gross income and are not considered estimated financial assistance for purposes of calculating awards. So they will not be included on either side of the financial aid equation there. They won't wind up on the FAFSA, nor will they be considered as EFA, or some people would refer to that as a resource. Okay, next I'd like to discuss some of the disbursement requirements related to HERF. And here we see that payments can be made using checks, electronic transfer payments, or EFT, debit cards, and payment apps, as long as they adhere to the department's requirements for paying credit balances. And those can be found in 34 CFR Part 668, Subpart K. Debts, charges, fees, or other amounts owed to the institution may not be deducted from the emergency financial aid grant. And finally, the emergency financial aid grant may not be made to students through the use of a credit card that can only be used on campus or in some type of retail outlet affiliated with the institution. Some other restrictions here: an institution may not reimburse itself with emergency financial aid grants for costs or expenses included but not limited to costs associated with significant changes to the delivery method. So if you're switching from brick and mortar to online, you cannot use those funds in order to pay for that transition in the mode of instruction being offered. You can also not reimburse yourself with emergency financial aid grants for any payments made from institutional funds to student employees working on campus jobs. Okay, let's look at the institutional portion. It's intended to cover any costs that are associated with significant changes to the delivery of instruction due to coronavirus. So this is different from the student portion. We're talking about the institutional portion now, and that can be used to cover those costs that are associated with a change to the delivery mode. And you may also use the institutional portion of HERF to provide refunds to students for room, board, tuition, other fees that resulted from significant changes to the delivery of instruction, including those interruptions occurring due to coronavirus. And you may also reimburse yourself, or the institution may reimburse itself rather, for refunds previously made to students on or after March 13, 2020. You may also use the institutional portion of HERF to make additional emergency financial aid grants to students for expenses that are related to the disruption of campus operations resulting from coronavirus. You may not use the institutional portion for payment to contractors for the provision of pre-enrollment recruitment activities, and this would include marketing, endowments, or capital outlays associated with facilities or religious or sectarian or religious worship. Next, we'll take a look at HERF reporting, and you can find details related to HERF reporting in the May 6, 2020 and July 10, 2020 electronic announcements. You must report on the required use of HERF funds, including all the following elements. So total amount of emergency grants distributed, the estimated total number of students at the institution who are eligible to receive a grant, the total number of students who have received a grant, the methodology used to determine which students will receive that grant, and also consumer information. Here's some resources available to you for HERF. And we have some guidance available at the website you see below the first bullet. There are some HERF FAQs. These are excellent, and they update these every so often. So you want to make certain that if you have a question related to HERF, you should look at that FAQ to make certain it already hasn't been answered. And finally, if you have questions that are not already answered in the FAQ section, you should refer those to herf@ed.gov. Next, let's take a look at some flexibilities related to the Title IV programs. When I had that timeline up, we indicated on that timeline a number of pieces of guidance that were offered between the 15th of March and now. And one of the major pieces of guidance we put out was an electronic announcement that was published on April 3rd, 2020. And some of the highlights here are the temporary cessation of educational instruction due to circumstances created by COVID-19 will not result in the loss of eligibility or participation. So those, if a school has to cease its operations due to the pandemic, then we will not consider that to be a circumstance that would result in that school's loss of eligibility. Institutions that cease instruction due to the pandemic should work closely with their school participation division regarding plans for reopening. So if you are an institution that has had to close, or perhaps given the spikes that have come in recent weeks would be forced to close again, you should definitely be in touch with your school participation division about the status of your institution. Continuing with the April 3rd, 2020 electronic announcement, we put some Clery guidance out there as well, because a lot of institutions had questions about how the pandemic impacted Clery requirements. So Clery Act requires institutions to notify the campus community upon confirmation of a significant emergency or dangerous situation occurring on campus. So how does that relate to COVID-19? Well, the department is not going to interpret the statutory language to apply to positive COVID-19 cases among individuals. So we're not requiring that you report the fact that individuals have contracted COVID on your campus. It also does not require institutions to give regular ongoing updates on COVID-19 or to proactively identify those cases. So in satisfying the requirements for Clery, we give you here what you have to do, or two possible options you have in satisfying the Clery requirements related to COVID-19. The first of those is to provide students and employees with a single notification through the regular means of communicating emergency notifications to inform them about COVID-19 and the necessary health and safety precautions that are out there. We also require that you include the CDC's COVID-19 website in that notification. Your other alternative is to create a banner at the top of your institution's homepage that would contain the same information, including a statement about the global pandemic and also providing a link to the CDC's website. I alluded a little bit earlier to the time frame for applicability, and going back to that graphic we showed you with all the various different types of guidance we have put out over the last couple of months, and ending with this August 21st, 2020 electronic announcement. This is a very important announcement because although it didn't offer any new flexibilities, it talked about what, for lack of a better word, I might refer to as the sunset date for all of these flexibilities. So unless it's otherwise stated in the notice, the department has extended the deadline for all flexibilities related to COVID-19 through the end of the payment period that includes December 31st, 2020, or the end of the payment period that includes the end date for the federally declared emergency, whichever occurs later. It appears now, of course, that the emergency will not be over by December 30th. Before we move on, I just want to say one thing that's not on the slide. Obviously, this pandemic is unfolding from month to month, and it is possible that the department will have additional guidance out there, perhaps offering further flexibilities and perhaps extending the sunset dates even further out. So you want to make sure that you are aware of that and are checking IFAP for any additional guidance which may be forthcoming. Okay, next I want to address need analysis. In our April 3rd, 2020 electronic announcement, we provided the guidance that any aid in the form of grants or low-interest loans received by victims of an emergency from a federal or state entity that is for the purpose of providing financial relief will not be counted as income when calculating the family's expected family contribution under the federal methodology, nor will it be considered as estimated financial assistance for packaging purposes. So these types of grants will not be considered on either side of the aid formula. I want to point out that one thing that is not covered by this flexibility would be institutional aid offered at state-related institutions. That does not fall under the aegis of financial relief provided by the actual state or federal entity. So that would still, so in other words, institutional grants would still count as EFC. Okay, on this slide we have a question and answer related to cost of attendance changes. And we received this question quite frequently over the last couple of months. So we thought it would be a good thing to include it in this presentation. So if an institution provides a refund for a portion of the cost for a student's room and board as a result of the outbreak, does the institution need to adjust student budgets? Do we also need to consider the difference in costs for students who must relocate to off-campus housing? What if we provide a partial refund of tuition and fees? So let's look at the answer to this question. If as a result of a COVID-19 disruption, you provide a refund or a waiver of expenses for all or part of a student's tuition, fees, room, board charges, or other institutional charges, or if you become aware that a student has moved off campus for the remainder of the term, it is not necessary to reevaluate the student's cost of attendance. And we put a note at the bottom here that this flexibility applies only to cost of attendance changes for an academic year if the disruption occurs during that academic year. Okay, next I'd like to talk about verification. And here we reference the April 3rd, 2020, May 15th, 2020, and July 9th, 2020 electronic announcements. And our guidance waives signature requirements where no responsible parent can be found. Obviously, that might be the case with some families as they're dealing with this emergency. We also have offered flexibilities in verification of non-filing and obtaining duplicate W-2 forms from the IRS. We also point out here that you may use documentation of high school completion that you already have obtained for V4 and V5 categories for verification, and you may accept a signed dated statement from the applicant attesting to completion of high school. Professional judgment. As you're aware, institutions have long had the statutory authority to use professional judgment, where in the judgment of the financial aid administrator, changes to the student's FAFSA data or cost of attendance are warranted. And in our July 9th, 2020 electronic announcement, we provided a little more guidance on professional judgment. Again, this guidance did not give anything to schools they didn't already have. It just provides a little more clarity. So what we're saying here is that we're encouraging institutions to provide professional judgment to reflect more accurately the financial needs of students and families who are affected by the COVID-19 pandemic. And we're also adding that for the 1920 and 2021 award years, we will make appropriate adjustments to our risk model and not negatively view increased use of professional judgment or use it as a selection criterion for program compliance review. I want to point out that we never view professional judgments in a negative note. So maybe saying that we won't view it negatively is not the best wording to use, but we never view it negatively. But we do, in most years, look at the incidences of professional judgment, and if they rise significantly, we may use that as an indication we should look at the school. But obviously, given the pandemic, those incidences of professional judgment are very likely to rise, and so we will not be factoring that into our risk model. Next, I want to talk about some academic calendar flexibilities we offered with the March 5th, 2020 and April 3rd, 2020 electronic announcements. All standard terms are now permitted to overlap adjacent terms without the program being treated as non-term. Normally, that would not be the case, and if you had standard terms that overlap, they would be non-term. Standard semesters or trimesters may now consist of as few as 13 weeks, and we do allow for reductions of defined academic years to less than 30 weeks, if approved by the School Participation Division, and we've given you the address there to request such a reduction in academic year. And it is applicable through the end of the academic year that includes the last date that the national emergency is in effect. So this is one of those exceptions, not through the end of the payment period, but through the end of the academic year that includes the last date of the national emergency, because schools normally plan for an entire academic year. Okay, at this point, I'm going to turn the presentation over to my colleague, David Musser. David?
Awesome. Thank you so much, Greg. All right, so let's get going. Along with academic calendar flexibility, we realized at the department early on that the COVID-19 national emergency would require us to waive certain requirements related to distance education. So we gave broad approval for institutions to use distance education, even if they've never done so before. And that included a waiver of the normal review process by the department, flexibility for accrediting agencies to waive their own requirements to review an institution's use of distance education. And all of these changes were intended to allow institutions to quickly shift from in-class or on-campus education to distance education if they needed to. Like many of the other waivers and flexibilities that we've discussed, these waivers will extend through the end of the COVID-19 national emergency. So now let's shift to some flexibilities for campus-based programs that were introduced in the CARES Act. So first, the CARES Act waived the requirement for non-federal matching funds for the FSEOG and federal work-study programs. Now, unlike many of the waivers that Greg and I have already discussed, this particular waiver applies on an award year basis. Specifically, it only applies to the 1920 and 2021 award years. And an important note here, the CARES Act specifically does not waive the requirement to provide a non-federal match for work-study wages at for-profit employers. So if you have any of those positions, you still need to ensure that a non-federal match is provided for those wages. Additionally, recognizing that many institutions had already provided a non-federal share for federal work-study wages in the 1920 award year, the department stated in our May 15th electronic announcement that institutions may reimburse themselves for the non-federal portion of wages that they paid to students on or after March 13th. So the other major CARES Act waiver described on this slide allows institutions to transfer up to 100% of their unexpected federal work-study allocations to FSEOG. This waiver recognizes that institutions needed more flexibility with their federal work-study this year because many students were not able to work the hours in their federal work-study jobs that they'd planned when facilities got closed or classes moved online and students went home. An important note here, the institution must participate in the FSEOG program in order to make this transfer, because you can't transfer federal work-study funds to FSEOG if you're not actually participating in the FSEOG program. So in addition to allowing schools to transfer much of their federal work-study allocation to FSEOG, the CARES Act also allows schools to use their federal FSEOG funds to provide emergency grants to students for unexpected expenses and unmet financial need as the result of COVID-19. These emergency grants can be no larger than the maximum federal Pell Grant for the applicable award year, and the CARES Act waives the institution's normal FSEOG awarding rules for these emergency grants. Finally, the CARES Act specifically states that FSEOG emergency grants are not considered estimated financial assistance, or sometimes called resources, for purposes of awarding other types of Title IV assistance. So make sure that you exclude these emergency grants when you package other types of aid. One thing I'd like to mention here is that we've been asked by a few schools whether they are allowed to use amounts transferred from federal work-study for traditional FSEOG awards rather than the FSEOG emergency grants described on this slide. And the answer to that is yes. Funds that are transferred under the CARES Act authority may be awarded as emergency FSEOG grants, as regular FSEOG awards that use the institution's normal FSEOG awarding rules, or a combination of the two. You can use it for any of those purposes. So the CARES Act also allows institutions to make federal work-study payments to students who are unable to work in their federal work-study positions due to COVID-19. There are several requirements for schools to do this. First, a student must have received a federal work-study award for the award year when the COVID-19 disruption occurred. The student must have already earned federal work-study wages for that award year, And finally, the student must have been prevented from working his or her scheduled federal work-study hours due to COVID-19. So now let's pause briefly to answer an important question about that CARES Act federal work-study relief. So schools have asked how to determine the amount of federal work-study funds that they can provide to a student when the student meets all of the conditions we described on that last slide. The answer is that the school may pay the student for any hours that the student was scheduled to work but was unable to work due to COVID-19. And in these cases, students should be paid the same wage rate that they would have been paid if they were able to work the scheduled hours. Keep in mind that even without the CARES Act authority to make federal work-study payments when students have not worked, another option is for schools to allow students to work by some other means, for example, by telecommuting and working remotely, if that's possible given the student's job. Remember that in those cases, a school has to ensure that it meets all of the normal federal work-study requirements, including obtaining a supervisor's certification that the student worked all of the appropriate hours. So in addition to the waivers offered by the CARES Act, the department took several other steps to offer flexibility to institutions regarding their campus-based programs. For the 1920 and 2021 award years, we waived the federal work-study community service requirements entirely for all schools. Those schools normally need to apply for a waiver of the community service requirements if they think they won't be able to meet them. Because of COVID-19, we're not requiring that application, either for either of those award years. The waivers are automatic. Additionally, the department will not be applying underuse penalties on the 21-22 federal work-study or FSA awards due to COVID-19. So if you find that you'll be returning more than 10% of your 1920 allocations, you don't need to request an underuse waiver. That waiver will also be automatic. So the department also offered some administrative flexibility regarding the timeline for appealing draft fiscal year 2017 cohort default rates. We extended the deadline for those appeals to June 30th, 2020. But keep in mind that we've not extended the deadline for appealing the official fiscal year 2017 CDRs, which were delivered to schools on September 28th, 2020. Okay, so now let's shift gears a bit and discuss the extensive waivers and flexibilities that have been provided to students who failed to begin attendance or who ceased attendance due to COVID-19. One of the very first actions that the department took related to COVID-19 was to prevent students from having to repay the full amount of direct loan funds that they received for a period when they failed to begin attendance. Normally, institutions are required to notify a student's direct loan servicer when they determine that a student has received a direct disbursement of a direct loan for a period where the student didn't attend. And that's so that the servicer can issue a final demand letter so the student will repay all of the funds received. The department waived that requirement for students who failed to begin attendance due to a COVID-19 related school closure. In this limited circumstance, those students will be permitted to repay the amounts they received in accordance with the normal terms of their promissory note for the direct loan. Now, keep in mind that what we're talking about here are cases where the student institution could not document any attendance, not cases where a student began attendance and then withdrew. We're going to discuss that latter case on the next few slides. Okay, so the CARES Act provides some very significant relief for students who begin attendance in a payment period or period of enrollment and subsequently withdraw from that period due to COVID-19. In these situations, the CARES Act does several things. First, it waives the requirement for the institution to return Title IV funds that it would normally be required to return under RRT4. Second, it excludes the period from which the student withdrew from the student's subsidized loan usage. Third, it excludes Pell Grant funds received for that period from the student's Pell Grant lifetime eligibility. And perhaps most importantly, it causes the direct loan funds that the student received for the period to be canceled entirely, resulting in additional annual and aggregate loan limit eligibility. So this relief applies to any student who begins attendance in a payment period or period of enrollment that includes March 13th, 2020, or begins between March 13th and the later of December 31st, or the last date that the national emergency is in effect, and the student subsequently withdraws from that period as a result of COVID-19 related circumstances. Now, we mention this time frame because it differs slightly from the general time frame for the department's waivers, and that's because RRT4 calculations can be performed on a payment period basis or a period of enrollment basis. So the CARES Act relief applies when the COVID-19 national emergency is ongoing during either a payment period or a period of enrollment, depending on which of those the institution is using as the basis for its R2T4 calculations. So what does it mean for a student to have withdrawn due to COVID-19 in order to qualify for all of this relief? That's an important consideration because so much depends on the designation. So there are really two ways that the department has designated that a student can be considered to have withdrawn due to COVID-19. The first way is described in the first bullet here. If a COVID-19 disruption occurred during a payment period or period of enrollment, an institution may consider all students who withdrew during that period to be withdrawn due to COVID-19. In that case, you don't need to consider each withdrawn student's specific circumstances when determining whether they withdrew due to COVID-19. This is a form of blanket relief for cases where an institution was forced to move its classes online or close its campus facilities during a term. So keep in mind that this only applies in cases where the disruption occurs during a payment period. It doesn't apply in cases where the institution changed its plans for instruction prior to the start of the term and informed students about those changes before they started. Now, the other possibility is that a disruption did not occur during the term, in which case the institution must determine whether each student withdrew due to COVID-19 on a case-by-case basis based on each student's attestation. The department provides broad discretion to institutions to determine what constitutes a withdrawal due to COVID-19, and we have some examples on this slide. Illness of a student or family member, the need to become a caregiver or first responder, loss of childcare, economic hardship, the inability to access Wi-Fi or the internet, or an increase in work hours, any of those things could qualify. Note that a student's attestation must provide a reason for the withdrawal other than simply due to COVID-19. The latter is not specific enough to qualify for the student for the CARES Act relief. So when a withdrawn student qualifies for CARES Act relief, the student essentially qualifies for all the Title IV aid that they could have received at the time of withdrawal, including amounts that would normally have been post-withdrawal disbursements. Now, we recognize that many institutions performed R2T4 calculations correctly back in the spring of 2020 before they knew that students would qualify for relief under the CARES Act. In these cases, schools need to identify withdrawals that are COVID-19 related, and they need to redisperse the Title IV funds that the student was eligible to receive at the time of the withdrawal. In these cases, you may need to apply for extended processing in the Common Origination and Disbursement System, and more information on that process can be found in breakout session number 6, the COD update. So let's pause again for another Q&A. So we've been asked by many institutions whether they're required to implement the CARES Act R2T4 relief, or whether instead they can return funds under normal R2T4 requirements even when a student has withdrawn as a result of COVID-19 and otherwise meets the criteria for relief. And the answer here is no. Once an institution has determined that a student has withdrawn as a result of COVID-19 and meets all the necessary requirements, the institution must not make returns under the R2T4 process. Keep in mind that if you have reason to doubt that the student's withdrawal is COVID-19 related, you may request any additional documentation that you think is necessary to determine the accuracy of the student's attestation. As I mentioned before, the department gives the institution the discretion to make this determination. Now, once you've determined that a student has withdrawn due to COVID-19 and qualifies for the relief, the CARES Act has two separate reporting requirements. First, you need to identify all of the direct loan, Pell Grant, and Teach Grant disbursements that the student received for the period in which he or she withdrew, and you need to add what we call the coronavirus indicator for those disbursements in the COD system. This is by far the most important of the two requirements because this is the way that you identify the Title IV aid that qualifies for CARES Act relief. Direct loan disbursements flagged with the coronavirus indicator will be canceled, for example. Now, separately, the CARES Act requires institutions to report the amounts that were not returned through the R2T4 process as a result of CARES Act relief. The department has modified the R2T4 tool in COD to allow you to do this on a student-by-student basis, or you can report this information at the institution level. And that second process will be released in 2021, and we'll provide more information about it in the future. But it's important to note that these are two separate reporting requirements. So the CARES Act also provides for some additional flexibility regarding your satisfactory academic progress calculations for students who are unable to complete coursework as a result of COVID-19. Institutions may exclude credits attempted but not completed as a result of COVID-19 from the quantitative component of their satisfactory academic progress calculations. And if an institution temporarily ceases operations, attempted credits for all affected students specific to that particular period may be excluded from the quantitative calculation. Keep in mind that the use of this flexibility is optional. Schools are not required to exclude uncompleted coursework from its quantitative evaluations, but the CARES Act gives you the ability to do so if you choose. Now, separate from the CARES Act relief, the department has been asked how pass-fail grading will affect satisfactory academic progress. And this is because many institutions shifted to a pass-fail framework in the early days of the COVID-19 pandemic and wanted to know how it would affect their satisfactory academic progress evaluations. And the answer to this is that you can allow students to take some or all classes on a pass-fail basis due to COVID-19. And if you didn't have a policy for allowing pass-fail grades, you can adopt one, even if only temporarily. Courses taken on a pass-fail basis count as attempts for SAT purposes, but pass-fail grades are not factored into a student's GPA. However, an institution may follow its own policy with respect to the effective pass-fail grades on GPA. So as you may know, there are some cases where a student ceases attendance but is not considered a withdrawal because the student is permitted to go on what we call an approved leave of absence. Approved leave of absences are not normally a practical option for schools with term-based programs because in those programs, when students return from a leave of absence, they're required to pick up where they left off on any coursework they were pursuing when the leave began. So the CARES Act waives this requirement, and it allows students in term-based programs effectively to go on leaves of absence, even between terms, without having to resume all of the same coursework that they've been working on. In these cases, the tuition and fees component of cost of attendance for any subsequent term or award year where a student returns from the approved leave of absence may not include the tuition costs for the coursework that the student was taking when the leave of absence began. However, the cost of attendance for a subsequent term or academic year may include living expenses, even if the student is enrolled in no additional credits. Additionally, credits associated with the coursework a student is completing upon return from an approved leave of absence may count toward that student's enrollment status. Aside from that CARES Act relief, the department is also allowing institutions that close due to COVID-19 temporarily to place students on a leave of absence until the institution can resume coursework, and that's normally not permitted. Additionally, in our August 21st electronic announcement, the department provided that leaves of absence that began on or after March 5th, 2020 may extend beyond the normal 180 days in a calendar period all the way through December 31st, 2020. So it's an extension on the amount of time students can be on a leave of absence. All right, so switching gears a little bit, the CARES Act also provided some substantial new flexibility to foreign institutions. Now, normally, foreign institutions are not permitted to offer distance education, nor are they allowed to enter into written arrangements with United States institutions to offer coursework to direct loan recipients. But in light of the COVID-19 pandemic, the CARES Act allowed foreign institutions to offer distance education or to enter into such arrangements with U.S. public or nonprofit institutions while a COVID-19 emergency persists in the foreign country. So this flexibility is in effect from March 1st, 2020 through the payment period following the end of the COVID-19 emergency in the foreign country. I reiterated that because it's important to keep in mind that that time frame for relief is dependent on how long the emergency lasts in the country where the foreign institution is located, not whether there's a national emergency in the United States. And as you can see at the bottom of this slide, the department also waived the requirement for the MCAT exam for foreign graduate medical school admissions because the MCAT was unavailable for a period of time earlier this year.
Congress recognized that COVID-19 would be disruptive to more than just post-secondary institutions, so the CARES Act also provides relief for certain teacher service provisions for teach grants and teacher loan forgiveness. For teach grant purposes, if a recipient's previously qualifying teaching service becomes part-time or is temporarily interrupted as a result of the COVID-19 national emergency, that teaching service is considered full-time and fulfills the service obligation requirement. This helps ensure that students' teach grants don't convert to direct loans because of interruptions related to COVID-19. Similarly, for purposes of teacher loan forgiveness, the CARES Act waives the requirement for teaching service to be consecutive for students whose teaching was interrupted due to COVID-19. To qualify, the borrower must ultimately resume teaching and complete a total of 5 years of qualifying teaching service, including teaching before, during, or after the COVID-19 national emergency.
The department also made some changes to enrollment reporting provisions here for students whose enrollment was interrupted by COVID-19, but who have not entirely withdrawn from an institution. So for these students who intend to return, the institution should continue to report their enrollment in NSLDS as in school and should continue the borrower in the same loan status, for example, full-time or half-time, until the student's next scheduled enrollment period, unless the student does come to you and officially withdraw. All right, so we've received a number of questions about cash management during the pandemic, but most of the requirements related to cash management actually remain in effect during this period, including early and late disbursement requirements and disbursement reporting timeframes. We recognize that many schools have altered their schedules in response to COVID-19, and in these cases, you might also need to alter the time frame for making disbursements, specifically early disbursements, if you generally disperse Title IV aid before the beginning of the term. You should contact your school participation division to explain the situation if you think that your institution will be completely unable to comply with the normal requirements. Note that final reporting deadlines are also still in effect, but if you need to make a disbursement late, just make that request with the Common Origination and Disbursement website or contact the COD School Relations Center at 1-800-474-7268. So given the extent of COVID-19 disruptions on campuses, we also extended several deadlines for other types of reporting and disclosures. The campus and fire safety disclosure must be posted no later than December 31st, 2020 now, and the annual survey will be open from November 18th, 2020 through January 14th, 2021. Similarly, the equity and athletics disclosures are required no later than December 31st, 2020, and that annual survey is open from December 2nd, 2020 through January 28th, 2021. And finally, the deadline for the FSA was extended until November 2nd, 2020. But please note here at the bottom of the slide that the FSA edit corrections deadline has not been altered. That deadline is still December 15th, 2020, so make sure you get those in on time. So we've saved some of the most important relief for our students and borrowers for near the end of this presentation. As you can see on this slide, the CARES Act took some significant steps to offer relief to student loan borrowers and effectively suspended 3 major activities on department-held loans: loan payments, interest accrual, and all forms of involuntary collection, including wage garnishment and treasury offset, have all been suspended. Additionally, payments that would have occurred during the suspension will count toward loan forgiveness, including public service loan forgiveness, and it will also qualify for loan rehabilitation or reinstatement of Title IV eligibility if the student otherwise meets all of those requirements. Because of all these interruptions, borrowers will not be required to recertify income for income-driven repayment purposes until December 31st, 2020. All right, on this slide, just a few words on financial statements and compliance audits. A March 11th electronic announcement provided for a limited exception for non-federal auditors to use alternatives to site visits. And the May 15th electronic announcement announced an extended deadline for compliance audits, essentially pushing back the institution's normal audit submission deadlines by 6 months. And finally, one last slide on the CARES Act revisions here, this time related to the Paycheck Protection Program created under Section 1102 of that law. So as you may know, the Paycheck Protection Program is a loan intended to help small businesses keep their workforce employed during COVID-19, and the loans can be forgiven if certain employee retention criteria are met, and the funds are used for eligible expenses. So some post-secondary institutions qualified for that program. And for those institutions, any loan principal that's forgiven under that program will be excluded from the total liabilities in the institution's composite score for financials purposes. That'll increase the institution's equity and net assets. And we also determined that federal work study recipients are excluded from the total number of an institution's employees for purposes of determining whether an institution qualifies for one of those Paycheck Protection Program loans. All right, so here are some resources that you can use as you navigate all of the department's COVID-19 policies for the Title IV programs, and we know that there are a lot of them. The first link here takes you to a variety of guidance for higher education related to COVID-19, including several links to important electronic announcements on the topic. And these electronic announcements can also be found on the Information for Financial Aid Professionals website that FSA runs. But the department's COVID-19 website is an easy place to find COVID-19 guidance, all collected in a single location. Now, the second link here goes to a series of frequently asked questions about COVID-19 and the CARES Act related to Title IV policy. But if you continue to have questions about COVID-19 Title IV policy, please contact the department at covid19@ed.gov, as you see here on the slide. All right, and with that, we will conclude our presentation today. Thank you so much for your time and attention. We know that this has been a challenging time for institutions, students, and their families, and we at the department are here to support you in any way that we can. So thanks very much.